Okay, let's just jump right into it because,
Okay.
wow, if you've been brave enough to look at your portfolio apps in the last 12 hours or so,
Oh, brave is the word.
you might be fighting the urge to, I don't know, throw your phone into the nearest body of water. It's Thursday, January 29th, 2026, and the vibes are frantic.
Frantic is putting it mildly. I mean, we're sitting at a fear and greed index of 19.
19.
That is deep, deep in extreme panic territory.
Exactly. We're watching Bitcoin dip down to around $87,500, which I know sounds astronomically high if you just time traveled from a few years ago, but in context, that's a painful drop.
And it's the contrast that's so stark. Look at gold. Actual physical gold just smashed through $5,000 an ounce. Historic record.
It's the ultimate decoupling event, right?
It really is. It's fascinating, stressful.
Yeah.
The whole narrative has always been crypto as a hedge, as digital gold. But right now, the market's bleeding out while the shiny yellow rock is just soaring.
So that's the scene. It is messy. But our mission for this deep dive is to, stop the doom scrolling and actually look at the machinery under the hood. We've pulled together a massive stack of sources for you today. We've got an investigative bombshell from the ICIJ on exchange security that is, frankly, it's going to make you sweat. A technical showdown between Ethereum and Solana from Backpack Learn, some market analysis from Binance, and a huge State of Crypto 2026 outlook from 21 shares.
And that's what's so interesting here, the contrast. If you just look at the price candles today, it looks like a total disaster.
Right. The world is ending.
The world is ending. But if you look at these reports, the underlying structure of the crypto economy is shifting in ways that are, well, arguably more bullish and sophisticated than ever before. We're talking about the end of the 4-year Bitcoin cycle, AI agents literally handling your money, and the return of the ICO.
Legal this time.
But legal this time, exactly.
Okay, so hold on to your hats. Let's start with the storm that's right in front of us. Why is everything so red today? What triggered this specific sell-off?
It's a classic black swan scenario. We're looking at a pretty serious geopolitical escalation involving the U.S. and Iran. That tension is just driving global risk aversion through the roof.
And usually this is where the crypto folks say, this is it. This is what Bitcoin was built for, safe haven. But the analysis we pulled from Binance from just a few days ago says that's just not what's happening.
No, not at all. We're seeing a historic divergence. Investors are piling into traditional safe havens. That's why gold's at 5,000. The yen is surging. Meanwhile, crypto is acting like a high beta tech stock. It's shedding value. We've seen over $12 billion in liquidations.
12 billion, just poof.
That's a lot of leverage getting completely flushed out of the system. Mostly long positions getting wiped out.
And what's interesting is the dollar index has fallen below 97.
Right. And usually a weaker dollar is great for crypto prices. It helps them soar. But right now, the geopolitical fear factor is just overpowering everything else. It's pure panic.
But it's not just the macro stuff scaring people, though. There's a trust element shaking the industry this week. We have to talk about this ICIJ report on Bitpanda.
This is such a significant story because it really challenges that narrative of the regulated, safe European exchange. Bitpanda is an Austrian unicorn, backed by huge names like Peter Thiel. Their whole brand identity is secure, regulated, and real.
They're the adults in the room, the anti-FTX.
Supposedly. But the ICIJ, and let's remember, these are the journalists who did the Panama Papers, they don't mess around. They got their hands on internal audit reports from Bitpanda's German subsidiary. And it is, well, you said it, it's messy.
Very messy. So they're talking about internal auditors flagging serious security issues back in 2023 and 2024.
Right, things like inadequate data storage, poor monitoring of service providers. But the real kicker, the part that makes you just stop, is the access rights.
Yeah, this part blew my mind. The report mentions that 2 shareholders and a board member had inappropriate privileged access to IT systems. That's basically a backdoor for the bosses, right, to mess with the tech stack.
That's exactly what it is. And in a post-FTX world, that is the ultimate red flag. You cannot have executives holding the keys to the engine room without oversight. And while Bitpanda told the German regulator, BaFin, that they'd fixed the problems, the internal auditors disagreed.
And this is a direct quote from the report, right?
Yeah. They wrote that the lack of documentation makes the company unexaminable.
Unexaminable. That is a word you never, ever want to hear about the place holding your money.
No. It highlights this huge gap between companies that look and act like banks and regulators who are struggling to hold them to those same standards.
And of course, Bitpanda says they pass all their external audits.
Right, but these internal documents tell a very different story.
Which brings us directly to what's happening today in Washington. It's no coincidence that on this exact day, the heads of the SEC and CFTC are meeting.
Paul Atkins from the SEC and Michael Selick from the CFTC, yep, they're discussing regulatory coordination. And when you see headlines like the Bitpanda leaks, you understand why the U.S. is still so strict. The industry wants to go mainstream, but you can't have unexaminable companies handling billions.
So, a market crash and a trust crisis. A lovely Thursday. But like we promised, we need to zoom out. Let's look at the tech. Because regardless of the price, the engines are still running. And in 2026, it feels like the battle lines have really solidified between the two heavyweights, Ethereum and Solana.
The Coca-Cola and Pepsi of blockchain.
That's the perfect analogy. And we've got a great breakdown here from Backpack Learn. So let's start with Solana. It seems to have officially claimed the title of the retail chain.
It really has. The numbers are
Yeah.
they're staggering. Solana is processing around 600 to 700 real-world transactions per second.
Per second.
Yeah, the theoretical capacity is way higher, but that's actual real usage. And the block times are 400 milliseconds.
400 milliseconds. That is literally faster than a blink.
Exactly. It feels instantaneous.
Yeah.
And the cost? A tiny fraction of a cent. It's basically free. That's why it's dominating high-frequency trading, gaming, consumer apps. If you're building something for regular people on their phones, you're probably building on Solana.
But it's had its issues, right? The report mentions the history of instability.
It's been 99.9% uptime lately, but yes, that outage stigma still lingers, especially for institutions, which is where Ethereum still holds the crown.
The secure giant.
Think of Ethereum as the settlement layer for high-value finance. It's got over 700,000 validators compared to Solana's 1,500.
No.
It's slower, yes. It's more expensive. Even on layer 2s, you might pay 10, 30 cents during congestion. But it is so decentralized and battle-tested. If you're moving $1 billion, you don't care about 30 cents. You care that the network never, ever goes down.
And speaking of Ethereum, they're not standing still. This Bean crypto report details their 2026 roadmap. They've moved to this biannual upgrade schedule, so what's coming?
We've got 2 major upgrades this year. The first one, in the first half of the year, is codenamed Glamsterdam.
Glamsterdam. I love it. Who names these things?
Developers with a very specific sense of humor.
Yeah.
But it's actually about really serious plumbing. It's focused on gas efficiency and something called enshrined proposer-builder separation.
Okay, let's unpack that jargon. Enshrined proposer-builder separation. Why does that matter to me as a user?
So right now, the people who build the blocks of transactions can sort of manipulate the order to make extra money. It's called MEV, and it leads to centralization. Glamsterdam basically builds a wall between the person who builds the block and the person who proposes it to the network. It's like anti-corruption software baked right into the protocol.
Got it. So it keeps the network neutral.
Exactly. And then the second half of the year, we get Hegota. But the 21 Shares report had this really brutal take on the whole Layer 2 ecosystem.
Oh yeah, for a while there, it felt like a new L2 was launching every week.
That party is officially over. 21 Shares predicts most L2s will not survive 2026.
They called them zombie chains, which is just a great name.
It paints a picture, doesn't it?
And back
And the data supports it. Activity on the minor L2s dropped 61% in late 2025. Liquidity is just fleeing. The market's consolidating around the giants. That's Coinbase's chain Arbitrum and Optimism. If you're a small L2 without a huge user base, you're probably going to zero.
Makes sense. Users don't want to bridge their money to 50 different little islands. They want to go where the people and the apps are. Okay, so that's the tech landscape. Let's talk about the money itself. The 21 Shares Outlook had a really controversial take on Bitcoin that I want to dig into. They're saying the 4-year cycle is broken.
This is such a pivotal shift in the mental model. For over a decade, everyone, and I mean everyone, traded based on the halving.
That 4-year clockwork.
Exactly. The boom, the bust, the recovery, you could set your watch to it.
And now?
Now, new issuance is less than 1%. It's lower than gold's inflation rate. The supply shock from the halving just doesn't matter as much mathematically anymore. But the bigger factor is who holds the coins. It's exactly ETFs, sovereign wealth funds, corporations. These aren't retail traders panic selling because rent is due. These are huge entities with 10-year horizons. The report highlights that volatility is compressing. We aren't seeing those 60–70% crashes like we used to. Drawdowns are staying under 30%.
Which, ironically, is pretty much what we're seeing right now. A painful drop, but not a death spiral.
Right. So Bitcoin is becoming boring. And boring is good. Boring means it's behaving like a real macro hedge, not a lottery ticket. It's maturing.
And the scale of this institutional money is just wild. 21 Shares predicts global crypto ETPs will surpass $400 billion in assets by the end of this year.
To put that in perspective for you, that would make the crypto ETP market larger than the QQQ ETF.
The NASDAQ 100, no way.
Yes, we're talking about crypto investment vehicles becoming larger than the primary vehicle for investing in big tech.
That's absolutely bananas, larger than QQQ. And we're seeing sovereign funds like Luxembourg's getting involved.
It's the financialization of crypto. It's not just magic internet money anymore. It's becoming a standard asset class in 401k.
Okay, so Bitcoin is the boring, stable big brother. But what about the bleeding edge? Because 2026 isn't just about ETFs. The 21 Shares report has a section on the agentic economy that sounds straight out of a sci-fi novel.
This is, for me, the most exciting part of this whole outlook. We spent years talking about AI analyzing markets. But now we're entering the era of programmable intelligence. AI isn't just watching the market, it's transacting in it.
So, robots with wallets.
Robots with wallets.
Yeah.
Think about Coinbase's X402 protocol, which allows machine-to-machine payments. Imagine an AI agent that manages your portfolio. It doesn't just send you an alert. It actively scans blockchains for the best yield, bridges your funds, executes the trade, and hedges the risk, all without you clicking a single button.
That seems incredibly convenient and also kind of terrifying. Are we comfortable giving an algorithm custody?
Well, we already trust algorithms to fly our planes and route our internet traffic. This is just the financial version of that. And the prediction is, if just 1% of global fund assets adopt these strategies, we're looking at $1 trillion of capital managed by AI.
$1 trillion controlled by bots. I guess that explains why prediction markets are also blowing up. That was another huge trend they identified.
Yes, prediction markets like Polymarket and Kalshi. 21 Shares thinks this will be the breakout sector of 2026, hitting $100 billion in yearly volume.
And we're not just talking about gambling on sports here.
No, this is trading events. Will the Fed cut rates? Will this bill pass Congress? Will the U.S.-Iran conflict de-escalate by February? People are using these markets to hedge real-world risk. And big tech is integrating it. X and Google are showing these odds right in the search results. It's becoming a kind of truth layer for the internet.
It's fascinating. It turns the news into a tradable asset.
It crowdsources the probability of truth.
Now, before we wrap up, there's one more Blyst from the past that caught my eye. The return of the ICO.
I know. Hearing the acronym ICO gives anyone who survived 2017 a little bit of PTSD.
Oh, seriously, I remember those white papers. Just 2 pages of buzzwords and a dream. We're going to put bananas on the blockchain.
Well, this is different. This is the regulated ICO. We're seeing platforms like Echo and Legion Coinbase actually bought Echo, facilitating public token sales. But they have KYC, they have AML checks. It's all above board.
So it's the IPO-ification of crypto startups.
Exactly. U.S. retail investors are allowed back in, but it's structured. You're not just sending ETH to a random wallet address and praying anymore. It's becoming a legitimate capital market.
Okay, so let's try to synthesize all of this. It's January 29th, 2026. The market's crashing. There's geopolitical tension. Companies like Bitpanda are facing trust issues. It feels like the Wild West is burning down.
But out of those ashes, a high-speed rail system is being built. That's the takeaway. We're moving from a cycle-dependent, volatile casino to a structured, institutionalized economy. Bitcoin is the stable collateral. Solana and Ethereum are the rails. And on top of that, you have AI agents and regulated capital flows starting to take over.
So it's safer, faster, but as the Bitpanda audit shows, you still have to watch out for the occasional derailment.
Always. Skepticism is still your best friend in this space.
So what does this mean for you listening right now? It means the game has changed. That simple buy and hold for 4 years strategy, it might be dead. The new game is about understanding these huge structural shifts.
And that leads to the most provocative question for me. If we're really moving toward an agentic economy, where AI agents are controlling trillions in capital based on on-chain logic and data, who or what is actually setting the market price anymore?
Oh, that is a heavy thought.
Seriously, think about it. If the majority of volume comes from machines reacting to data faster than any human can even blink, are we just becoming spectators? Are we just watching the algorithms fight it out?
Humans as spectators in our own economy.
Yeah.
Wow. I am definitely going to need a coffee to mull that one over.
Just don't check the charts until after the coffee kicks in.
It's a deal. Thanks for diving deep with us today. Stay curious, stay skeptical, and we'll catch you in the next one.